Inflation up, markets rallying. What's really going on? Let's break down the latest CPI report, its impact on stocks, and why the market's big surge might just be getting started. CPI Inflation Report, Key Updates and Market Impact. The Bureau of Labor Statistics (BLS) released the latest CPI inflation report this morning, which had notable effects on the stock market and interest rates. Here's what you need to know. Inflation data highlights. Headline inflation increased to 2.9%, up from 2.7% last month. Core inflation improved slightly to 3.2%, from 3.3% last month. Federal Reserve target. Both figures remain above the Fed's goal of 2.0%. Market reaction. Stock market rally. Despite the mixed inflation report, the market surged. Interest rates fell after the report's release. Why did the market rally? The market was bracing for worse inflation data following last Friday's stronger than expected jobs report. 256,000 jobs added. However, inflation figures did not exceed expectations, which was enough to fuel optimism. Additionally, strong earnings reports from major banks contributed to the market rally. Federal Reserve interest rate outlook. Next Fed meeting, January 29th. Chance of rate cut, unchanged at 2.7%. According to the CME Fed Watch tool, March meeting odds. Chance of no rate cut decreased slightly, from 76.9% to 74%. Is the major market surge ending? Answer: no, it's not over. We're still in the early stages. Root cause? The federal government's debt crisis. As long as the debt crisis persists, the major market will continue the surge. Short-term market volatility is a natural part of this phase. Inflation categories breakdown. Here's a summary of inflation rates for key sectors. Shelter inflation, 4.6%. Services inflation, 4.4%. Food inflation, 2.5%. Energy inflation, 0.5%. Food inflation year-over-year changes. Fish, minus 0.7%. Bread, plus 0.3%. Fruits and vegetables, plus 1%. Milk, plus 1.9%. Butter, plus 2.5%. Meats, plus 2.7%. Coffee, plus 3.8%. Eggs, plus 36.8%. Household financial expectations. According to the Federal Reserve, expected expense growth in 2025, 4.8%. Expected income growth in 2025, 2.8%. This disparity highlights the ongoing financial strain for households, with expenses rising faster than incomes. Key takeaways. 1. Inflation progress stalled. Headline inflation rose, and core inflation improvement was minimal. 2. Market rally explained. Strong earnings reports and relief from worse-than-expected inflation data boosted the stock market. 3. Economic concerns. The gap between rising costs and incomes remains troubling. 4. The long-term outlook. Stocks tend to rise over the long run, primarily due to inflation devaluing the dollar. Investing remains critical to keeping up with inflation. Rising prices, market moves, and what it all means for your wallet. Stay informed and stay ahead. Don't forget to like, subscribe, and share for more insights into today's economic landscape.